Hi everybody, this is the Jigsaw trading Q&A from the 23rd of March. Now unfortunately this was our first Q&A that we were going to start last night, and a tree effectively took out my internet connections, so basically we couldn't do the Q&A. Now a lot of people today have emailed me asking for the video, so what I decided to do was go through the first set of questions, and it's actually a good set of questions to go through for the first Q&A. So I've decided to go through those today in this video, and then you can email me questions or ask follow-up questions on this for the next Q&A. So obviously first we'll put in the disclaimer. This is a risky business. We are going to talk about trading today. We are going to talk about where I personally enter the market. That's not a recommendation specifically for you to take trades. You have to figure this out in terms of your own risk profile as well. So I'm talking about how I trade this with my risk profile. I am quite risk averse. You might actually find that you take more risk than me. Now, the most popular question we got was, where do I get in? Where do I get out? Now, that question really in itself is a bit like saying, how do I trade? And so it's a small question with a big answer. So I think it's something we need to cover anyway, because I think if we don't cover this question at this point, it's going to come up in every Q&A. And I'm going to go through, I'm going to deal with this question, and I'm also going to tell you how to ask the same question next time. Okay? With this question, I'm going to answer it in such a way that possibly the person asking the questions are going to be disappointed. Might be disappointed now, but if you actually follow the advice, it'll probably be a turning point in your trading, specifically because you're asking this type of question. Now, when most people start trading, they start off with indicator-based systems. So, for example, a moving average crossover, where lines cross and you enter a trade, and when they cross again, you exit. So they're looking for a specific signal, and a fairly simple signal, something that really a monkey could train. So pretty much looking for a graphic to tell them when to press a button. And that is not trading, and it's not even close to trading. That's just pressing buttons when two lines on the screen cross. And the issue with it is you really have no reason to enter the trade other than lines cross, and you can't take any action when the system stops working. In fact, if it even worked in the first place. So the reality is that when you buy, you do so because you expect other traders to buy after you and to move the price up. And two lines crossing is not a reason for other traders to buy after you. Okay? If you thought other traders were looking at those two lines, they'd enter at the same time as you, price would pop a little bit, and then it would just flatline because everybody would be waiting for somebody else to buy after them. So we can say that traders looking at things like a moving average crossover are probably not yet mature in their trading knowledge, and they don't expect to ever get to the point where they could define their own trade entry and exit criteria. So many people, and I know how this sounds because I've been that person, you see as almost impossible the ability to define your own entry and exit points. You think that's just something only a few select gurus can do, and that everybody else that's trading is actually following one of those gurus. Okay? And really it's a lack of understanding what trading is and a lack of confidence. So what we're trying to do at Jigsaw is slightly different, and we believe that to decide where to enter the market, you first need to get an understanding of participation, an idea of where traders may come into the market and where they may be getting stuck, and a way to clarify or verify that they're actually doing that at the time. So you need to know when the market has slowed down to the point it's not worth trading, and you need to know when it's so fast you can jump in without worrying too much about the trade location. We also know that when you start to see certain events for yourself in real time, you'll be very close to be able to define your own trading technique. Now, that doesn't mean the way you trade has to be new and unique, just that you're putting the pieces together for yourself. And we're going to look at what the pieces are in a second. So we're trying to give you those pieces, give you an organic feel for how traders are behaving so you can make your own trading decisions. Now, you might think that this is a cop-out. Okay, you might think, this guy can't tell me where to get into and out of a trade, and he's just bluffing. He's just trying to talk around it because he doesn't know. And that's not, honestly, it's not it. It's just you have to take responsibility. And I'm not holding back on anything either. You might think, man, why doesn't this guy just tell me? He's telling me to take responsibility. He's giving me all this stuff about teach a man to fish. Like, why don't you just cut through that and tell me? And it's because I can't. It's impossible to tell you where to take a trade. Okay? I'm going to kind of tell you, but you've got to see these things for yourself. You've got to do the things that you like to do. And you've got to start implementing things. And then when you have trouble, then we can talk. So to look back to the question, it is impossible to answer the question because the answer for any trader is the sum total of their experience. So some days I have trades I will take right after the open, sometimes in the first minute. But other days I will pass on those trades because I don't like the way the market's behaving. And to sum that up, it's just experience, basically. And as you get more experience, you'll take more trades. And as you get more experience, you'll see more things and react to more things. So what I can do is give you pointers based on information you give me. So if, for instance, you tell me how long you've been trading, how you define a trade location, how well that's working for you, what your experience is order flow, what's working with you from order flow, then I can absolutely help to give you a push in the right direction and give you some ideas of what you might want to do next that you can then try for yourself and see how well they work for you. And sometimes you might ask me something that's out of my domain of expertise, and then what I will do is I'll actually go and ask somebody else that question and come back to you with what they say. So basically, if you've got questions about how to trade, tell me what you're doing, what's working for you, and then I'm going to be able to say, okay, look at these specific things, and then you can come back after you try those specific things and certainly ask again. So in future Q&As, I'm going to put in a note that any where do I get in questions will only be dealt with if you can provide information about what you're trying and what you're struggling with. Okay, now what you're struggling with could be, I just don't have any clue at all. Okay, and that is absolutely fine. That is absolutely fine to say that, because we can deal with that. We can say, okay, you've got no clue at all. First, follow these things. So I'm going to talk about those people who are still looking for a signal and saying, I've got no clue. So first of all, what I would do is I would suggest the first place you go is we've got a video called Day Trading for Dummies. And this video discusses what trading actually is philosophically. What is it you're actually trying to do? Now, of course, trading is buying and selling. But this talks about what is your place in the market and what is the place of other participants and how do you react to each other and how do you look at yourself? Because so many people see themselves as a speculator, somebody who's trying to make a few ticks out of the market, and they see the market as something else. Some people see the market as this massive algorithm. Some see but nobody, generally speaking, people don't see the market as lots of people like themselves. So that's the first step. Then if you're new to Jigsaw tools, we've got the second video, number 2. This is drills for both new users or even old users that thought they could skip the drills. So a lot of times we get people that come to the tools and we say, okay, do this first, and they don't. They just go in to start trading it, and they could go in 6 months later and still not really have an appreciation for what the tools are showing them. And these drills do that. So these drills are where you get your first taste for the events that move the market, as well as events that should cause you to step aside. The next one, number 3, day trading without charts. This is a discussion on using intraday volume profile for short-term trading. And that does discuss trade entry and exit points. And the reason we advise this one first is before you get into charting analysis and longer term analysis and trying to take 10-point trades on the ES and 100-tick trades on crude, you need to learn how a market builds and how to potentially scalp a few ticks out of the market. And the way you're going to do that is by trading off the volume profile. So the day trading without charts isn't something that's an advanced technique. It's actually something that you should probably consider first before you kind of step into longer term analysis. Because the longer term analysis, if I look at a day or if I look at a few days, so for instance, if you look at my pre-market prep from yesterday, the 23rd of March, I had some expectations about the volatility for that day and the previous day, in fact. And those expectations came through watching the markets every day for years, basically, which I do. I watch the markets every day and watch them play out. And I know that, when we have a couple of days that play out in a certain way, we have some expectations how the next day will play out. And that kind of thing, that kind of level of experience is only going to come if you watch lots of days. And of course, there is only one day every day. So you're only going to learn about one day each day. So 6 months, 9 months of watching the action play out every day is going to give you a better feel for, how a day plays out and how the previous day might influence the next day. But of course, you don't want to wait 9 months before you start making profits. And that's why we say, okay, go to the day trading without charts, look at that and see if you can help to define areas where you can start pulling ticks out of the market. Now, for longer term day trades, really, we're looking at swing charts. The stuff that we've got on swing charts, so that's just a search for swing charts on. There's a few articles and stuff. And that's a look at how to define trades based on weak pullbacks and how to set bias so that you're actually looking for pullbacks in the right direction. I would say that's kind of a level up in terms of trade location from the day trading without charts. And then we have the ES when to enter. Then we have the ES when to enter, which is a course that customers get free when they buy the tools. And it's just a course about trading, finding trade locations on the ES. And it's really, you could look at it. It's basically an expansion of what we've got on the swing charts there. So a complete novice, having gone through all this material, should be able to then put together a set of rules and try them for a few weeks and then come back to us with the results and their questions. So what I'm saying is there's a lot in those videos that you can use to say, right, this is, based on what's in those videos, this is how I'm going to put this together. You don't have to say, I'm going to take every idea from those videos. You could say, right, day trading without charts, I know that volume's going to build in areas and I can scalp around that volume that builds in areas. So I'm just going to focus on that and try to make money that way. And then this is what I'm going to look at in the order flow, based on the new to Jigsaw tool stuff. And you could just say, right, I'm just going to start with that. And then you try that for 30 or 40 days or whatever, however long you think you need. And if it doesn't work or it doesn't, along the way you're struggling, then let's have a look at what you're doing and why you might be struggling. There might just be something obvious you're missing. And it's much better to do it that way. But even if you're doing it that way, you are really at that point starting to look at, you looked at the new to Jigsaw tools video. You've seen how markets move. You've seen people step up and absorb selling. You've seen then somebody come in and start buying. You've actually seen participants hold and then push up a market for a reversal to occur. So you've actually seen those things. Whereas with the moving average crossover, it either works or it doesn't. You've had there's no basis behind it in terms of behavior that you can actually see. But when you start looking at this behavior and seeing this behavior, you say, well, maybe I'm just going to wait for the guy to start absorbing contracts and then get in. Or maybe I'm going to wait for him to start buying and then I'm going to get in then. And it's entirely up to you. But at that point, you're actually using your knowledge of the way the market moves to define how you trade it. And you are trading your own style at that point. And it's a big and scary thing, trading your own style to a new trader. But just with this stuff, it's absolutely possible. It's absolutely possible. And then you've kind of got a bit more control, because if it doesn't work, you can look at what you're doing and say, well, why doesn't it work? Or we can have a chat about why it doesn't work. So I'm saying, a complete novice going through all this, you should be able to try it, put some rules together, try it for a few weeks, get back to us, and that's my approach to how I'm going to enter this where do I get in question. Now, what I'm going to look at, we've got some other questions. So that's the first one, where do I get in, where do I get out? The next one, if you entered a trade and it goes in your direction, do you use any strong liquidity levels building up behind you in Auction Vista to trail your stop loss of the contract still open? And what we'll do, we'll just bring across Auction Vista. Okay, so what we're actually looking at here is we're looking at the mini Nikkei 225 trading on Osaka. And specifically, what would we look at on the Auction Vista if we're in a trade on here? And should we be looking at just the bids and offers, or just looking at the liquidity building up behind us? Well, if we look at this, we can see as we came down here, we got the market was thickening up. and then we started to move up. Basically what we're seeing here is traders starting to get trapped here, and then we start to move up. And we can see that as we move up, we don't really see significant liquidity building behind the move. And it's not to say that doesn't happen, and it does depend on how thick the market is. If we were looking at the treasuries, let me just bring up the treasuries. We can see that a market like this, as we move up, we do see liquidity behind and we do see liquidity above. And that's mostly because we're on a thicker market. And what we're actually seeing there, more likely, is top of the book market making strategies playing around the bids and offers as we go up. So, you do see that kind of activity there, but you can also say, well, it's above us and below us. And it's just because it's a thicker, less volatile market, and there's a lot more market making activities going on there. So I would say purely in terms of staying with a trade, market depth below you doesn't help. What does help, I'll say a few things off Market Vista. First of all, if you see massive bids come up below you, it's most likely a spoof, and you've got to be really careful when that happens. So if you've just got into a trade and you see a ton, maybe 3 or 4 levels, really, really high bids below you, I would say that's not a good thing to do. And if you just got into a trade, certainly for me, if I've just got into a trade, I'll exit a trade if I've just got into it and I'm still close to my entry point. So I think that's a sign the market's going to collapse. So no, I wouldn't look at that. What I do look at though, if we look at this market that's moved up, we can see we moved up to here. And then what we did, we kind of moved around sideways. And if we consider this area here, this is a bit of a consolidation area. We can see, we got large size there. We got large size here, until we finally, we had a bit of large size and a bit of extra liquidity here until we broke out. What I'm looking at is actually looking for this to hold, this area to hold. So as we move up, I'm expecting just to see a move up, some consolidation, a move up, some consolidation, and a move up. And only when one of these consolidation areas breaks the other side, do I then think, well, the market's going to move in the opposite direction. So we had this move up. We got some absorption as we moved up there, a little bit high liquidity, came down, went sideways, another consolidation zone, and then that one broke to the downside, and then we're on our way down. So effectively, that's the way I look at the market, purely from a Vista point of view. One of the things to note, though, if you have a really low volatile or low volume market, you're going to get a less clean move. So if the volume really drops, you're going to see it going up, wiping out the high volume node, going back up the other side of it, and you don't get the market stair stepping up. You get the market kind of just running all over itself. But effectively, from here, what you'd see here, this would be a high volume node on the volume profile. This would be a high volume node on the volume profile. So if you look at the day trading without charts video, you'll also see in there an explanation of why that's kind of the way to watch a market in terms of trends. Just by move, build volume, move, build volume, move, build volume. Then it's going to wipe out volume to the other side. Those guys are going to get stopped out, and then we start making a move in the other direction. Now, there are some other things I look at in terms of staying with a trade. And do you have a slide on that? Let me just get the video up. Okay, so here it is. This is the video. It's called Kill It or Keep It. And that's a video basically talks about what to watch on the strength meters and how to use the strength meters to stay in a trade, how to use correlated markets, how to use the volume nodes being crossed. So it talks about all the different things that I use to stay in a trade. You don't need to use all of them yourself. It's just the different things that I use. It's not too difficult. It's just a matter of keeping your eye on a few different things. It doesn't talk in there about Auction Vista, but what we've just gone through should be enough to get you through what you need on, the additional things you need on Auction Vista. I will do this webinar again, including Auction Vista. So on to the next question. So how do we determine reversals or continuation in Auction Vista or through other tools? Well, there's two kinds of reversal that occur in the market. There's a full reversal, which is if the market's in an intraday trend, market will often put in 3 or 4 opposing intraday trends. And so I call those full trend reversals a full reversal. And then the other kind of reversal is a pullback. And generally speaking, the pullback and the full reversal are different in terms of participation. If you look, for instance, in this example here, what we see is a market that's coming down, and as we come down, we see that we've got more selling than buying. We've also got a lot of size. So here we've got 1,300 sells by 883 buys. Here we've got 1,200 by 399. So we see size trading, which effectively means if there's more red than blue here, it means the bidders are absorbing contracts. So let's just think about somebody who's got to buy a lot of contracts. What they're going to do is basically buy contracts, and not necessarily just going to hold the market in one place. They're going to buy contracts on the way down, and as long as they've got active sellers selling, they can just add to their bids and just buy more contracts, and keep doing that. At some point, they might feel that they're running out of sellers, and they've still got more buying to do, so they go from being a passive buyer to being an active buyer and actually start buying. And also what we see, if the market does move up, we're going to see these guys start to realize they're getting stuck. So what we're seeing on the way down, we're seeing absorption, we're seeing it over a range of prices. And then we see finally, if we look at this zone here, we've got a lot of trade in this area here. Finally, the market pops up through that area. We come down and test, and then market takes off again. So it's a combination of, on the way down, bidders absorbing and then seeing the buyers come in more aggressively. And you can get in anywhere between the bidders absorbing and the buyers coming in, and which is why we say, define your own trade rules. So that's a full reversal. And so, it takes more to make the market reverse than it does for a pullback. The pullbacks are usually one of two things. They're usually, we build a range, okay, so we move up, we build a range, and on the charts, on the time charts, you'll probably see this looks like a pullback, but we'll build some volume, and the market will tick up and down, just ranging around that volume. And the trick there is you buy the bottom of the volume area, try and scalp some at the top, and then hold for a runner, basically. So that's one type of pullback. The other type of pullback, we've got a couple here, is, we've got another consolidation area here where we move sideways. We break it down, come back up to test it. And this is more typical of a pullback where effectively what we're seeing more than anything else is a lack of participation. So you're seeing the market come back. There's weak volume. There's not a lot going on. We've already had our breakdown. We've got the volume up here. We've broken it to the downside. We think we're possibly in a confirmed trend to the downside now. You just see this weak pullback where there's just not a lot of activity. You can see it on the charts here. It's also really easy to see on the depth and sales. You can actually see it on the swing charts as well. We've got the low here, and again we come down, and just again a weak pullback. So the pullbacks are kind of different from the full reversals, where they're more defined by a lack of activity. And I know that sounds like it's going to be hard to look for, and that's why you do the drills. But to actually look at these pullbacks, to have this confirmation, if you look at the day trading without charts, if you can kind of get this confirmation that the market really is in a downtrend, and you know how volatile the market and the kind of pullback sizes it's putting in, just wait for the market to come off, and you'll just see a lack of willing to trade. Not many contracts traded. Every time it ticks up, it immediately ticks back down. And that's really the kind of activity you look for in the pullback reversal. Now, how to spot supply and demand with Vista or volume profile. Okay, so these would be, shorter term supply and demand zones. And again, you've seen this occur once here and down here. This is just the current chart. Obviously, if you then come back to this area and you see another big circle, come back to this area, see another big circle, come back to this area, see another big circle, that is really confirming that you've got supply in that area. So one hit is kind of like a heads up. But if you keep going back and you keep seeing supply there, then obviously that's another heads up too. And again, what you're going to see at this area, you sometimes see a high volume area on the volume profile, but this area here isn't going to be as high volume as this area here where we kind of stood trading for a long time. So this area here would probably at some point be the point of control. But up here you can see, okay, we hit supply, we came off it. We didn't really test it again to see if there was more supply there. But effectively what you're looking for is the absorption zones. have charting, which is very good about helping me find zones of support and resistance. How do I combine Auction Vista with these zones to maximize my entries and exits? Okay, so the easiest thing to see, as we've already talked, a major reversal, because I don't know if you're looking at major reversals or minor reversals there, but a major reversal, quite often you're going to see the absorption, and then you're going to see the buyers kick in, or you're going to see the absorption at the top, and then you're going to see the sellers kick in. So that's one thing to look for. But of course, it's not always going to reverse like that. So the absorption is quite often one of the first signs to reversal. The other thing you're going to look at is for depth. Okay, now depth on its own I wouldn't trade, but if you've got depth and that depth has been there for a while as you come down and it doesn't move away, okay, so if I come down and the depth is there and the kind of as I tick down the depth moves down, that's not real, okay. But if it stays at that level, or even better, if it starts to move up to meet that level, then that's definitely a good thing and definitely kind of an affirmation. As you move into that depth, if it suddenly pulls, okay, then it's just fake anyway. So you might trade 20 contracts, it pulls. If we trade into that level and that depth stays firm, it might not stay white because it might reduce in size. But if they stay firm and trade it, again, that's another heads up. Another thing to look for is just getting to your price and just nobody wants to touch it. So you might come down and trade your price. Nobody wants to touch it. So, we might, if we look up here, we ticked up to this price. Just stay there for a second, came down. So we're going sideways, tick up that price, can't stay there, come down, go sideways, tick up again, can't stay there, come down, move sideways, and then the last time we tick up again, can't hold. And that's just basically a lack of willing to trade at a price. And that's another thing to look for. It's not as obvious as the absorption and the depth, but it is just as powerful. And then the other thing that's going to happen on occasion is you're just going to come to your level and it's just going to go whoop and reverse, because buyers come in. So, market's moving down, buyers come in, moves up, and it's like over in a fraction of a second. And you don't really have time at that point to react to it. But what you do is you take that as a sign, okay, the buyers came in, now I'm going to work an entry. So now I'm going to look for my weak pullback. So maybe if just the buyers are coming here, I'm looking for my weak pullback, maybe a little bit of absorption on the pullback or just this lack of willing. And look at that way. So it is a sign of strength when buyers step in. But obviously not all signals are going to come through fast enough for you to take them. Sometimes the market just does reverse on a dime. And I think that's all our questions for today. So I do really apologise for the lack of me being on live last night. So I hope this answers some of the questions. Feel free to give feedback on the YouTube comments or send emails for the next set of questions. And we'll see you next week. Thank you.